everyone, and thank you for joining us today. I am very pleased to have Ankit Jain join me today. Ankit manages our midcap fund, our multi-cap fund, and also co-manages our large and midcap fund. First, congratulations, Ankit, to your fund, Mirae Asset Midcap Fund. The baby is now 7 years old.
Yeah.
So it's been a very interesting journey over the last 7 years, and I'm sure you would like to share some of the learnings that you've had in the midcap fund.
Yeah.
So maybe can you share how you've seen the last 7 years of this fund?
No, absolutely, Vaibhav. If you're looking into last 7 years, as if the extent of events we have seen in last 7 years, it looks like it might have been far longer time.
Sure.
I mean, so we launched in July 2019, then COVID happened immediate next year, and then post that we have seen this geopolitical sort of an issues continuing every now and then.
Correct.
So extent of volatility, has been significantly higher.
Correct.
Right? In that context, I will say this as a segment has actually stood the time very, very well, right?
Sure.
I mean, mid-cap as a segment, if you're looking into last, let's say, 7 year, earnings CAGR would have been north of 15% for the segment.
Yeah.
And this speaks about the entire India story and the way maybe companies has been able to move up the value chain.
Correct.
You're looking into the overall size universe, I mean, that has compounded multifold.
Correct.
Right. I mean, from let's say almost the entire universe has widened 3-4x market cap, balance sheets, cash flow size, and all. Everything has actually compounded 2-3x at least. Right.
Correct.
So in this context, I think it becomes extremely important to be basically to stick yourself with the right sort of investment philosophy in terms of identifying businesses.
Correct.
And market will keep on throwing surprises, right?
Absolutely.
I mean, there could be different cycles, and more so in current sort of a times when there is no dearth of volatility news around. But just stick to your basics, try to identify good businesses, make sure do not overpay.
Sure.
Because sometimes in mid-cap, that also becomes very, very important given limited set of universe of 150 names.
Sure.
There will always be the case that names with good earnings visibility might be trading at a very, very high valuations. But then idea will remain to have a very well-balanced approach. And that is how we have tried to navigate in the last 7 years.
Sure. So Ankit, over the last 6-7 years, the mid-cap index itself has changed a lot. So you got a lot of IPO listing. The market cap of the 101st company has changed a lot, maybe 5 times during this entire period. So how have you seen the entire mid-cap index itself changing?
Yeah.
And how would you say, when this entire index itself changes, how would you make changes in your investment process?
Absolutely. If you're looking into 7 years back and now, from largest company 28,000 crore has become 1.05 lakh crore as of now, right? So almost 4x jump. So that is one. But even more importantly has been the extent of newer businesses which has come up.
Correct.
I think those has become incrementally even more and more important part of it. And many of these businesses, whether new age businesses you're looking into in the fintech side, in the insurance side, in the consumer discretionary side, there has been whole host of these new businesses getting added, has made universe even much more vibrant.
Sure.
In terms of your ability to pick and choose these businesses. So construct has changed quite a bit.
Sure.
And so is our ability also to identify some of these businesses, because to value them with the traditional sort of a mindset might not be able to justify.
Correct.
So for us also to be able to identify some of these businesses has required some bit of a different mindset in terms of mapping overall opportunity side.
Sure.
And then what could be the true potential sustainable profitability in actually many of these businesses. So that I will say would have been one very big change when it comes to the evaluation of businesses. Apart from that, it has been same sort of a sectors, companies might keep on changing here and there. But I think universe now versus 7 years back has changed quite a bit.
And Ankit, maybe in the case of mid-cap, especially because you have to invest at least 65% of your portfolio, and the universe is 101 to 250 to make the investment. So how would you define your investment process and thought while selecting stocks? As well as what is your risk process to ensure you don't overpay, you don't over-allocate to companies? Can you highlight?
No, you're absolutely right. First, in terms of the universe restriction, yes, 150 name is what you have to pick and choose at least 65% of your portfolio. So see, I mean, typically how our approach remains that 2/3 of the portfolio always remains in high quality growth oriented businesses and all. And typically you try to size it up, many of those businesses when let's say cycle might not be good, right? Because that is where, I mean, you do get valuation in your favor, right? So that is how typically, I mean, our sort of a style has been. At the same time, you look into 1/3 of the portfolio, try to add through some sort of a value approach where you do see maybe growth construct might not be strong double digit, growth construct might be single digit, but valuation gap is very, very high. That might be an additional layer. And then third bit is trying to play bit contra, trying to play bit ahead of time into the businesses where there might be temporarily dislocation in earnings. But I think underlying business fundamentals as well as longer term growth prospect remains intact. Then you try to pick and choose these sort of businesses. So that is how it has been the approach. And when it comes to in terms of managing risk, so managing risk is couple of factors. One is the overall portfolio liquidity. So we are having very strong guardrails around that through our risk management team. That what percentage of portfolio can get liquidated in 5 working days, 15 working days and all. And on all of those count, I think it do still stand out fairly well. And this is despite of the fact that AUM seeing disproportionate growth during time, because with size and all, some of those constraints even becoming higher. Second is around try to have portfolio active dates, right? I mean, how does it work, right? So typically our idea always remains from the portfolio construction wise not to take excessive risk. Right? Idea will always remain risk adjusted return across the cycle. So we have internal guardrails in terms of how much stock active bait you can take. So typically that range around 3.5-4% on the higher side. So that is one. And then sectoral diversification is an added layer, right? Which to help you even withstand your mistakes, right? I mean, in case if you get your sector call wrong, then
it gives
then also sectoral diversification to actually help you mitigate some of those. So yeah, I mean, that is how it is.
And for the remaining part, how do you allocate between large cap or small cap?
That is again depend on bottoms up ideation at any given point in time. But how we have been running is 10 to 15% in large cap and at around 15% into the small cap, and mid cap has been 70% throughout. And it is not as if compulsorily we have to invest that much in large cap, that much in small cap. That is again boils down onto the opportunities, right? As I mentioned, let's say financials, if we are positive, and if large cap bank itself are looking much cheaper, so then rather you are better off taking some of those exposures. Similarly, let's say it could also be a function of some of the sectors and all where let's say that sectoral representation might not be in case of mid cap, but might be available, let's say, in case of large cap. So this is a function of one, relative valuation. That is one. And second, in case of additional sectoral exposure which you might want to take, which otherwise might not be there in case of mid cap universe. So some of that thing.
Fair. So at this moment, Ankit, which are the sectors you are sort of very positive on, and which sectors do you think you will take an underweight?
So sectorally, no, I think even in the context of mid-cap universe, if you try to look into, again, financials remains key overweight sector, particularly private banks at this point in time. NBFCs are also looking very, very interesting because interest rate cycle, I don't think that is going to see a very big upsurge from here on. And they are decent quality AAA rated NBFCs being sort of available. That is another aspect. Insurance is actually another thing which is looking very, very interesting given valuations where they are, and it is a high growth area. Apart from that, we are positive on pharmaceutical, which includes contract manufacturing, CRO, CDMO part of it. Again, very, very structural, long-term sort of a growth growth story. Within infrastructure, at this point, we are positive on cement, metals, and also logistics side of it. These are offering decent sort of opportunities at this point. Incrementally, we will be a lot more positive on some of the export stories. Where maybe across various sectors, chemicals, then maybe industrial consumable, auto ancillaries and all, which can meaningfully benefit from this, all of these trade deal getting signed, right, with UK, US, EU. I think some of these will become very, very interesting. Apart from that, we are very positive on all those new age businesses. Which sits across different areas, maybe be it, let's say, insurance platform, be it BPC platform, be it fintech side of it. Some of these are like very, very high quality businesses, market leader, long sort of a runway for growth, run by very strong management. So these are the areas typically we are positioned much more. In terms of underweight stance is more around, let's say, FMCG, IT. Some of these areas, apart from that, capital goods. Some of these areas is what we are underweight.
So, Ankit, we've seen that the mid-cap index is at all-time highs and continues to do well. So, considering the valuation, considering the earnings growth, do you think that the mid-cap index can continue to deliver strong growth over the next maybe 3 or 5 years?
Yeah, absolutely. So if you're looking into the earnings construct, right, even let's say fiscal year 26, midcap has been the segment which has delivered the highest earning growth, 26% earning growth. Yes, some part of it might be inflated because of certain commodity companies and all posting very, very good set of numbers, and which will reverse a bit. But having said that, at this point, next 2 year earnings forecast is around 17-18%. That is a very, very healthy number. And in that context, valuations, I will not say they are very, very cheap. At 1 year forward, 28 times price to earning. Historical context is around 23-24x. So they are reasonable, right? I mean, while I think last 7 year returns has been disproportionate, right? I mean, at around 23% CAGR for the underlying benchmark. But then in case if return expectations are realistic from here on, I think earnings compounding will actually definitely play out. Valuations has come off from peak. September 24, 1 year forward was 35x. Which has come down to 28x. It has come off, but is still higher than the historical average.
But earning growth looks strong, and new companies are getting listed.
Yeah, earnings growth, and second most importantly is also the entire construct ROI of the index itself has gone up. Because balance sheet has been deleveraged over time, and with quality of companies are also actually improving, which is also reflecting in higher sort of valuation multiple versus historical context.
Okay, in this context, how should an investor approaching investing in a midcap? What is the time frame that they should look at investing, and how should they invest?
No, midcap has to be a core portion for actually any investor allocation. Percentage might vary depending on to the risk profile, but it has to be a very, very core segment, because this is one segment where the composition of index in itself is such which can definitely take care that earnings compounding remains far higher than any of the other segment of the market, right? And which has been the case last 10 years and might as well be the case for next 10 years as well, right? So in that context, I think with this portion remaining core, maybe depending on to 25-30%, up to 25-30% of the allocation has to be done. And as I mentioned, sometimes if your entry valuations are right, you might ended up making far higher returns, right? That has to be the approach. At this point, I will say valuations are reasonable. So to that extent, with maybe realistic return sort of an expectation.
And they should invest at least 5 years?
Yeah. So see, higher is better, because in mid-cap, apart from earning growth, a large amount of returns also do get made by way of valuation re-rating. Right. So if you give companies enough time, then in that process, valuation re-rating also do play out as an added component for the returns.
So thanks, Ankit, and congratulations again on completing 7 years, and hopefully you continue this growth momentum and deliver far better returns over the next 7 years as well.
Thank you, Vaibhav. Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.